We're very strong proponents of having an index position as a core part of the portfolio, and that's because on those days, and we've all experienced them. There've been really three over the last 2 weeks when all the leading stocks get hit. Really, what's happening is if you take a look at the RSP. And the S&P 500, money wasn't leaving the market; it was just flowing from one sector to another. So every point lost in technology was a point gained by financials or
Right.
medical or industrials. And that RAIR is aggressive index reentry. This is something that we came up with after the 2022 bear market to uh, get back into the market quicker while you're not necessarily sure what the indexes are going to be.
Hmm.
Because if you're struggling as a trader and even managing money, the question we get is, what's the S&P 500 doing and how are you doing against that? Well, we're going to be out of the market when the market uh, is ugly below the 200-day moving average, but we've got to have plans to get back in because if the market takes off higher to the upside without you and leading stocks aren't set up, you can at least take advantage of that index gains. It doesn't matter how you get your gains, unless you've got an ego problem and you don't say, I don't want to be in the boring indexes. Well, do you want to be cool or do you want to make money? And
Right.
we can certainly make money in the indexes when they're going higher as well.
I mean, it's certainly fun to have all the hot stuff when you're at a cocktail party, but at the end of the day, um, you know, wait, how much money are you making? Because you can have small positions in a lot of the hot stuff, and it's like, oh, is that even moving the needle for you? But you can say that you own it. Getting back to your ego part, but let's go ahead and move on to the stock selection because again, I like to sometimes start with the indexes. Either I think this time I was actually a little bit more tentative. I was doing more QQQ and SPY before I kind of ramped up to the TQQQ
Yep.
and UPRO. Actually, I was just more TQQQ this time around, but eventually I start looking a little bit more at the individual stocks. So, how do you go about doing your stock selection?
Well, what we're looking for in an uptrend, and I've got a chart the next to the last slide. We'll see it. We have a strategy called the EZ8E, and the strongest stocks you will notice they trend up along the 8-day exponential moving average. Some people use the 10 simple. They're very similar. These are the names that we're looking for. It does no good to buy a slow name if you don't just want to get the S&P 500 return because growth stocks should return 2 to 3 times. So that's absolutely what we're looking for in our names. We want those names that when the market's going higher, they're riding the 8 EMA higher. They're showing much stronger gains than the overall indexes are. But that part of the index can also be in SSO or SPXL or UPRO, which are ETFs that return 3 times. So I would rather buy one of those than buy a stock that I hear the term Chris Gessel uses all the time. This is a market stock. You don't want those in your portfolio.
Mhm.
There's no reason to take a market stock when you're getting individual stock risk. You might as well be in the index taking that risk and having it being spread among 500 stocks and
Yeah.
getting the same return. So that's why the relative strength line is so important on every chart. You really
Hmm.
want those things where the relative strength line is trending higher.
Hmm. Now, when something breaks that trend, a lot of times it's very temporary. So,
Right.
how much room do you give it?
We give it 2 to 3%, and it's dictated by the ATR of the individual name. So,
Hmm.
you absolutely do see that all the time. You see intraday, it'll tuck below the 8 EMA, but end up closing back above it. So, we found that given that 2 to 3% below the 8 is enough room to keep you in it, along with the proper sizing. If you've got a 15% position and you're down 7% on the day and it breaks the 8, you're going to be tempted to get rid of some of that. I'd rather have the 4% position and know I'm giving it a little bit more room and smooth the equity curve intraday and long term.
Yeah, absolutely. So to kind of break this down on the stock selection side, of course, there's the buy rules and the sell rules. So Can you walk us through a little bit of both to kind of
Yeah,
determine how that
most
happens?
of our buys and sells fall into these categories that I have there: volume gaps, whether it's on earnings or a news catalyst, or volume breakouts from sound bases.
Hmm.
And then those are the ones where we take our initial position, whether it be a third size, a half size. But then we look to add to that. If you can't get your full position on right away, we look to add on strength after weakness, so post weakness.
Hmm.
And a tactic that we use all the time is a pullback on the to the 8-day EMA. And again, the 8 EMA should be, if the stock's going to keep going, that should provide the support that you're looking for. And if you
Hmm.
combine that with the stochastic data that you get in Market Surge, you'll see a 60-minute stochastic cross, and it's a great low risk entry because if it works, you've got great. It should, because if the market's strong and the stock's strong, you should continue to ride the 8 EMA higher. If it doesn't work, that's maybe telling you something about the individual stock, or maybe the market is weakening.
Right.
And in addition to those pullbacks, the traditional pullbacks to the 21, the 10-week moving average, and the 50 or the simple 50 simple moving average those are just classic ads.
Hmm. And then on the
So
sell side?
yeah, on the sell side, offensive selling is critical. I think that one of the mistakes that newer traders make is they think that every stock that they buy is going to be the next big thing. It's going to keep up going forever. They never take profits on the way up, and then when you get hit with one of those days where all leading growth names get hit, you give
Right.
back all the gains that you made over the last couple of weeks in one day. But taking some off on the way up, and we like to use an ATR extensions from the 21-day moving average. And usually when we're doing this, we're looking, and it's no guarantees, of course, there are no guarantees in the market, but really what we're looking for is to add that position back and maybe a little bit more when it retraces back from this extremely extended condition. So it's
Hmm.
really a temporary thing. You don't know if you probably didn't get the top, but if you did, at least you locked in some gains.